ton capacity, taking our total capacity in the eastern zone to 26.2 million tons. Central will see an addition of 5.1 million tons, taking us to 28.4 million tons of capacity. West, a small 1.8 million tons of capacity, taking us to 29.5 million tons. North, Pali, which was long overdue, will see light of day by end of December 22, and adding 2.5 million tons of capacity in North, taking us to a total of 26.3 million tons. South remains the same as 20.5 million tons of capacity. We will close financial year 23 with a capacity of 130.9 million tons in India and 5.4 million tons in the UAE, thus taking us to 136.3 million tons. This capacity is clinker backed with 11.4 million tons of additional clinker coming up, 2.7 million tons in each in North, Central and East, 1 million ton in Mahir, which is again Central, and Dalla Super, which is part of UP and part of Central, will hopefully, and we are confident its 2.3 million ton clinker capacity will get commissioned during the next financial year after resolution of all the pending legal issues. Pali integrated plant with a grinding capacity of 1.9 million tons and Cuttack grinding unit of 2.2 million tons, along with a small grinding unit at Dhule in Maharashtra of 1.8 million tons are the three greenfield projects, and the remaining capacity is all brownfield. This will help us keeping the overall project cost at well less than $60 per ton as total capital cost, reducing our overall fixed cost and generating higher returns. One more point that I must mention is our focus on green energy. We are investing in WHRS and all the clinkerization units. 40% of the power requirement of this expansion will be through WHRS. At the end of this phase of expansion, our green energy is likely to be 34% of the total power consumption, as against 30% target that we had pre-expansion. Another important point in our focus on sustainability is that 85% of the output will be blended cement, thus improving our overall blending ratios and reducing carbon emissions further. Needless to mention, we are fully secured for limestone post-expansion. As far as cash flows are concerned, the revised capex estimates, capex cash flows are 2,500 crores per year going forward. This would include the capex for the expansion as well as ongoing maintenance capex that the company would have year on year. With this capex spent, we are not changing our goalpost of deleveraging. We will be debt-free company by the end of fiscal year 23. This is all I think I had to tell you about the expansion plans. Wishing all of you a very safe journey through COVID, and with that I will hand over for questions, if any.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask questions may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Indrajit Agarwal from CLSA. Please go ahead.
Hello, sir. Thank you for the opportunity. I have a couple of questions. First, on the balance sheet strategy, we have maintained we are comfortable with 1 times net debt to EBITDA. So how should we look at that over the next both in the near term and also in the medium term? Does it mean that we will be looking at more greenfield, brownfield expansion much more than what we have announced now, because we'll end up being net cash by FY23?
Indeed, as I had mentioned, I have told in the past that we have a game plan of about 50 million tons of expansion, organic expansion. We are ready with it. However, this expansion will be focused on, the timing will be focused on the right opportunity being there, as in demand, sufficient demand being there, and we don't have enough capacity. So we are geared up for the remaining 30 million tons in the year by the year ending 2030. That's clearly on the radar. Second point, I think you mentioned about leverage. Leverage is a very comfortable position. Last quarter, we ended with 1.22x. I will be below 1x by the end of March 21. And taking on the additional capex spends in the next 2 years, which is fiscal 22 and fiscal 23, in spite of taking on the additional capex, we will be debt free by the end of fiscal 23.
Sure, that's helpful. My second question is on the capex per ton. Now, if you just do a simple math of 6,500 crores capex on a 19.5, it comes to less than $50 in fact. So when we calculate, are we assuming or incorporating some of the land cost that we have already incurred in the past when we say it's less than $60?
No. So the land cost, which has already been incurred, has got factored in the original cost of expansion. But this is the incremental cash flow which will take place, except for Pali, where we have factored in the land cost, and Cuttack, where these are greenfield projects. Hirmi, which is the other brownfield expansion, Mahiya, which is the brownfield expansion, Dhar, which is the brownfield expansion. The land cost got factored in the original project itself. If you were factoring in land again, then it no longer remains a brownfield.
That's helpful. And one more, if I may. Other than WHR, any other power capacity you are adding in these? Any CPP, thermal power capacity? If you can quantify that.
No, only WHRS. Only WHRS. About 50, 57 megawatts of, 57, right?
Yes.
57 megawatts of WHRS. And we have our thermal power capacity available, which will, if any shortages there, will be supplied to these units by way of power wheeling within the states.
So we will not depend on grid power or outside sources of power at all, even for these expansions.
No. So we maintain a grid connection for the purpose of emergency.
Sure. Thank you. Thank you so much, and all the best.
Thank you.
Thank you. The next question is from the line of Gunjan Prithyani from JP Morgan. Please go ahead.
Hi, thanks for taking my questions. Just two questions from my side. So firstly, what made you press the start button now? Is it, you're feeling so confident about the demand that, we had to go ahead with these expansions right now? Or is there a capacity share target in your mind that, in 5 years or in 10 years, we want to, get to this much capacity share? We've clearly had a great journey going from 10% to 22% odd capacity share. So how should we think about, the top-down approach on capacity expansions from your side?
Capacity share is never a target. It's a profitable growth, the target. And we will put up capacity if we start falling short of capacity in a particular region. Because, the question comes back that overall capacity utilization is only 75%, then why are we adding capacity? However, India cannot be looked at as one single market. It has to be looked at state-wise or region-wise, depending upon which region we are falling short of capacity. Today, we are falling short of capacity in East, and I think I must have definitely told all of you in the past that we move material from South, we move material from, in peak times, we move material from Maharashtra right up to Odisha, or from UP to the eastern markets. So now that we are falling short of capacity, we had decided to go ahead and press the button on expansion, because this will also take every year. While FY23 end will be the completion of the expansion program, but every year we'll have some amount of capacity going on stream. And yes, we are very confident of a 8% CAGR growth in the next 10 years or so. Definitely, things are changing in the country. Government is getting more serious. Today, I have reasons to believe that payments to contractors are bang on time. All the infra projects are going through the roof. You are seeing lots of projects getting initiated, work commencing, and once this momentum picks up, there is no looking back. Aided by the fact that fiscal 21 is, in the first quarter, Gunjan, if you had asked me, we were looking at a degrowth for this year. Second quarter, the degrowth became smaller. The expectation of degrowth became smaller. And by the time we are reaching third quarter, I think we will have a growth in this financial year, which should be looked at along with the 2 months which were washed out. So effectively 10 months of sales, and the third month of the year was also a ramp-up month, which is June 20. So in this kind of mode that the country is in, we are seeing opportunities of rapid growth in the coming years.
Has there been any change on the urban housing side in the last couple of months?
Urban housing side, urban housing is improving, except for luxury housing. I see the urban markets also coming back on stream. There's a lot of demand which we are seeing in tier 2 towns finally waking up, which had died post demonetization. It's finally starting to revive now. The need for space is becoming more urgent, and decisions are being preponed, partly because of COVID, also aided by the fact that there are brilliant opportunities, as in there are good offers being given by real estate players. There are housing loans at a record low cost. Government is also giving a lot of SOPs for reviving the demand for urban housing.
Okay. The second question I had was on the capex and ease. Now, I understand the shortage that is there in that market from your perspective, but it's also been a market where pricing has been very, very volatile, right? And the ROEs that a lot of people make in East are still not, are not attractive enough. So I'm just thinking the thought process in East, I mean, given the pricing pressure, do we, is that the expansions there also, fit the IRR or ROE criteria that you have in mind? I mean, I'm just trying to understand the thought process in East, because it's been one market which is continuing to see a lot of pricing pressure.
Yes, pricing pressure do exist, but it's a very stable earnings market. I have seen earnings of 900 rupees or 1,000 rupees EBITDA per ton on a consistent basis. Chhattisgarh state, by the way, is the lowest price market across the country. But yeah, we are not dependent on Chhattisgarh. Bihar, Odisha are very good margin markets. That's where the focus will be. And to your other point, our ROCs, I think I have included a chart in the presentation. The ROCE or a project IRR from this expansion is upwards of 15%.
Okay.
Barring Pali, which is a greenfield project, so because costs are higher, others being greenfield or others being brownfield, and more than 70% of this expansion is brownfield. So you can do your maths. 15% is only an average. So the other projects are phenomenally higher on ROCE. This will help improve overall returns on the company balance sheet.
Okay, got it. Just one clarification, and I'll move back in the queue. This 6,500, if I just take on 19.5 million ton grinding capacity that you're talking about, it's about $50 a ton. So, and you mentioned $60. So I'm just trying to think, what is the $60 number that's there in the
I said less than $60. So.
Okay, got it. Thank you so much. I'll join back the queue.
All right, thanks.
Thank you. The next question is from the line of Ritesh Shah from Investec Capital. Please go ahead.
Hi, sir. Thanks for the opportunity. Sir, a couple of questions. First is, would we have any targets in mind specifically for Birla White, RMC and UBS? I think it's for the first time we have detailed out the specifics. Specifically on Birla White, are we looking to double capacity? How should one look at the market share over here? That's on Birla White.
Yes.
And likewise for RMC and UBS. That's the first question, sir.
Okay. So all the three segments and the fourth one, which is building products or construction chemicals, all the four segments are highly profitable, high ROC, and Ritesh, you have always talked about Birla White. Yes, we are looking at expanding our presence in the white cement and putty. We will come up with a plan shortly. I know the shortly has been quite long, but yes, we take time. But once we get going, we really get going. So white cement is gonna expand. RMC business. Currently, we have about 102 plants. By the end of this fiscal, I will add at least 20 more plants. RMC is becoming a very big opportunity. By the way, it is an incremental margin over what grey cement earns. So it's not a dilution in margin for the company. And I think I've given the numbers. It must have consumed more than 1.3 million tons of cement. So it is a customer for grey cement. So it's a very attractive proposition. The country is changing, moving towards RMC, but there's a long way to go to emulate the Western world. UBS, we are at about 2,300 stores. The plans are afoot to double the size, more than double the size in the next 3 or 4 years. Construction chemicals, wherever we have, what we started doing is the investment requirement is insignificant. We are now tapping into opportunities available within our existing manufacturing plant facilities where we can add on a separate section to develop the construction chemicals and give a run for the money for other players.
That's encouraging. Sir, would you like to put some numbers over here, given UBS is a big growth optionality that we have, and we haven't, I think Street hasn't appreciated that. You did indicate probably you're hinting towards captive manufacturing on construction chemicals, which is quite positive. So would it be possible for you to quantify some numbers over here, because it's a big optionality which as a company Ultratech has. How should one look at it?
So, one is the grey cement sale itself, which takes grey cement and white cement sale itself, which takes place from the UBS network today. As I mentioned, from the current 2,300 stores, we will be galloping towards doubling the size in the next 3 or 4 years. That will be a critical mass and a force to reckon with. And I think UBS is doing a fabulous job. The kind of services, the features that even Vastu services available there for individual home builder or paint gallery option. I was also not aware, in fact, paint gallery is an option, or the various chemicals, etc. that are made available. As far as financial numbers, not yet. I will, once we are ready, we will detail out the financial numbers as well.
Great. So just two more questions. We have, you did indicate WHRS to address 40% of the power requirement on incremental expansions, and you did emphasize on blended cement. Sir, would you like to qualify any emission targets? I know that we have it, but would you like to revise those milestones that we already published, specifically given our incremental initiative over here?
This is, let's say, give or take 18% of our existing capacity, and the with the given the blending ratios, improvement in blending ratios, improvement in the power, green power. Earlier we were looking at 30%, now it goes up to 34% on a 130 million ton capacity. The emission norms will strengthen further. I don't have a number. It might be in decimals only, obviously. Once the sustainability report is finalized, that number will be tabled. You should expect that in the next annual report.
Great. And so just last question, you have indicated like 22.3% is a market share. Sir, any sense on how much will be our market share on FY23 basis, looking at the industry capacity additions?
So this is not market share. This is capacity share.
Yep. Sorry.
There is a big difference. There's a big difference between market share and capacity share. Yes, we will the capacity share basis the announced plans. And this is my reading of what will actually come. We should be upwards of anywhere between 23 and 23.5% capacity share. Market share will be higher.
Correct. Sir, any targeted number over here?
There's no target.
No target.
There's no target.
Perfect. Thank you so much, sir. I'll join back. Thank you.
Thank you. The next question is from Gaurav Rateria from Morgan Stanley. Please go ahead.
Hey, hi. Sir, two questions. Firstly, if I look at the current profitability of the company, my assumption is the brownfield projects will have even higher profitability given the lower overhead expenses. So on those profitability metrics and the capex cost per ton, the pre-tax ROC comes around 25% plus. So I'm just trying to understand what is the entry barriers for the industry, because a lot of companies can actually add capacity on brownfield basis. The ROC pre-tax basis is 20-25% plus. So what really are the entry barriers which can stop other players to add capacity and spoil the whole pricing scenario for the market?
The entry barriers are readiness. We've been investing in land and mines over the years on a consistent basis. Everybody does not do that. People are short-sighted as compared to being long-sighted. So short-sighted decisions are never thought through and have resulted into disasters in the past. There are only a few companies who have who have the preparedness and who have limestone. And we are aware that limestone post-expansion is not available with all the players. So that becomes a big entry barrier for any brownfield expansion.
Got it. Sir, secondly, on East market per se, how is our cost competitiveness versus peers? Because I think the clinker transportation cost is still pretty high for us, and there are some players where the clinker transportation cost will be very low for some of them, so they can always afford to be much more competitive and try to gain market share, which is why pricing can always be a problem in east market. So how are you thinking about it?
So, for example, we are adding 10 million tons in east and another 5 million tons in central. Out of that 5 million tons, Ankit, Mayer is how much?
1 million.
So, about out of this 19.5 million tons, 11 million tons is in the eastern markets, which de-risks us on profitability because of high logistics cost.
Okay. So last question on your assumption of ROC 15% plus, you would have baked the current profitability to sustain throughout, or what's the sensitivity one should kind of think about with respect to current profitability sustaining or not sustaining, and you still achieving your targets of 15% plus ROC on these projects? Thank you.
My expectation is that the profitability will improve for us.
Got it. Thank you.
So, yeah. As I mentioned, there's a chart in the presentation, Ankit, showing the existing ROC and the project IRR. So I am conservative in giving my numbers.
Okay.
Thank you. The next question is from Amit Murarka from Motilal Oswal. Please go ahead.
Oh, yeah. Hi. Good evening, Mr. Daga. Just a few questions. Firstly, after 2023, there's a 30 million ton expansion which is showing till 2030. So that seems to be a low CAGR of 3%. So how should we read it? Like, is it like the 30 million ton is on the drawing board and there could be more coming up till 2030, or is it like a 30, it will not exceed 30? So how should we read this?
So this 30 million tons is, we are prepared with it in terms of land and mines. We are prepared with it. This, our growth, hunger for growth, will also be met by inorganic opportunities which could come up in the next few years. And we are not stopping at this 30 million tons. India is a high growth market. I would say India is the highest growth market, and Ultratech is seized of that opportunity. I think ready for the next generation also.
Sure, thanks. And on the northern market, like Pali, grinding seems to have been scaled down. When it was announced earlier, it was a 3.5 million ton grinding, and now it seems like 1.9.
Yes, I have surplus grinding capacity. So basically, we wanted to see how we improve returns on Pali. So it's reducing the investment a bit at Pali, and the surplus, the clinker that is being generated at Pali, we have surplus capacity in other northern grinding units. So we'll use that as an opportunity to improve the overall returns of Pali. Earlier, the plan was on discharge at 3.5 million tons. It has been scaled down to 1.9 greenfield. Correct, Ankit?
Yeah.
1.9.
Okay. And also in the same context, like UNCL, there was expected to be a brownfield expansion. So is it beyond? Is it in the 30 million tons beyond 23?
The 30 million tons, yes.
Okay. And in the existing expansions which are there in East, like Dala is mentioned as 1.3. So there is no mention of the clinker at Super Dala. So I believe that's also coming through, right?
Yeah, I did mention about the clinkerization capacity which is coming through. We will finally see light of day on the Dala Super 2.3 million tons clinker.
Okay, and the timeline, I think the last one was mentioned as yes, it was mentioned as June 23.
Last month, yeah, right. June 23 can be touch and go. June 23? No.
Sorry, 22.
No. 22 is too far. We would look at it before December 21.
Okay.
Just to give you how things are bad because of COVID, the MOEF meeting which was scheduled last month was cancelled because four out of the quorum was not there because members were down with COVID.
Okay.
So these are unfortunate times. That's all. But everything is under control now. I'm very relaxed about Dalla Super. Now it's gonna see through.
Sure. Thanks. That's all from me. Thanks.
Bye.
Thank you. The next question is from the line of Vivek Maheshwari from Jefferies. Please go ahead.
Good evening, Atul sir.
Good evening, sir.
Sir, a few questions. You gave numbers on national market share. Is it possible to get, the regional, the east and the central targeted market shares in 2023 and what those are currently?
I never gave market share numbers.
Capacity share. My bad.
Capacity
Yeah,
share.
my bad.
So I have, it becomes unnecessary complication in market share.
Right.
I have given the capacities that we will reach. I can offline give you the estimates on the overall industry. I don't have it ready, that's why. Give you offline the overall industry, expected industry by FY23 so that you can calculate the number. We will be reaching on a capacity share, we will be reaching close to 30% for sure.
I see. Okay.
Average,
I'll take it.
average across. Yeah.
Right.
I'll give you offline.
Separately take it.
Tablet.
Sure. And I know this question has been asked a few times on this call, but I'm still, I still want to ask the same one, which is, the announcement timing and the fact that, we have seen a similar thing from, let's say, Shree, JK Cement, a bit from Birla Corp and JSW. There are quite a few, players who have spoken about it and have hinted that, there are a few more coming in foreseeable future. Does that not worry you from a margin? So if you are saying that, profitability will keep improving, but the issue that I see is if your capex cost itself is like, $55 or thereabouts, the hurdle rate from a return perspective is even lower than what it is for, let's say, so to speak, existing capacity. Is that not a worry, because obviously as a leader, you can always get aggressive and in a bid to gain market share, and there are capacities, coming up from competition as well.
Yeah, so it is not a worry, Vivek, as I mentioned. Limestone will be a constraint for several players. Either you buy limestone under auction, existing limestone mines, I'm sure everybody has that data on existing limestone mines of each and every player. People might not take risk of brownfield expansion and reducing the longevity of life of mines and putting the entire project at risk. So everybody will not be able to expand. Everybody will not expand.
No, but Atul sir, I mean, the point is that, you don't need everybody to expand, right? It's just in every cycle we have seen, it's just let's say, depending on the region and the concentration or fragmentation, we need, let's say, between 2 and 7 players to basically, if it is south, it is 7, and for other markets, it can be just 2 players adding capacity aggressively. For example, east, there are a number of players who are adding capacity, and now you will also add quite a bit to that. Wouldn't there be a big issue from a competition perspective because the players will want to ramp up capacities and so on and so forth, right?
Yeah, but they should have limestone, my friend. And the leader rules.
Leader rules.
There can be only one line in the
Leader rules in terms of ramping up, right? That doesn't guarantee the pricing bit, right? I mean, I just bring back that JP Associate ramp up, which you did a few years back, right? That can create a bit of an uncertainty in those markets, right? At least for a couple of years as you ramp up. And obviously there is Dalmia which is ramping up. There is Ramco which is, or rather Dalmia which is adding, Ramco which is adding, so on and so forth, right?
Yeah. So East
I mean,
is
my
a
only point
market
is that
which
your
is grown.
Please go on, sir.
East is a market, Vivek, which is growing very fast and will keep on seeing growth. The kind of numbers that I've seen on the potential, the per capita consumption in the country has risen from 190 kgs to about 227 kgs over the last 3 to 5 years. And Eastern zone is way below. This is an average numbers of obviously the Gujarat and the Maharashtra market is higher, but Eastern market is 200. Ankit, do you remember the number?
Yeah.
Tell me.
Yeah. So Eastern is around 200.
200 kilos is East, which is the lowest. Central is also as low. There's a huge amount of consumption possible. The market will absorb cement. So one doesn't have to play the price game to absorb it. Today, I have to, as I mentioned earlier, we incur maybe 400 odd rupees a ton additional logistics cost to service the market. That cost will not be required. There will be a realignment of capacity so that I can focus my south capacity on south or Maharashtra capacity on the Samruddhi Expressway only instead of moving material to east.
Right.
I don't foresee a challenge.
Right. I mean, on one side your costs will be, more optimized. On another side, the capex cost is so low. So my only worry, as I said, is, maybe the prices are kind of peaking now, and at least in the medium term, because the hurdle rate for you to generate returns is far lower, because $60 or $55 is a very attractive price, right? So even if you take a current EBITDA per ton of, let's say, 1100, that is a huge return on the incremental capacity. So that's the worry, but I hear you. Thank you and wish you all the best.
No. So Vivek, just to
sure. Yeah, please, sir.
$55 for us is because it's all brownfield. Everybody will not be able to do brownfield. Greenfield, the cost of greenfield is going up because cost of mines is going up because of auctions. And the moment the cost, so that has an impact on the operating cost, because it's a royalty cost, annual royalty cost that goes up. And because of auctioned mines, land is just not available, or land cost has gone up. So everybody will do their maths right. I hope they do their maths right to get into an expansion decision.
Sure. Thank you, sir, and wish you all the best.
Thank you, sir.
Thank you. The next question is from the line of Ashish Jain from Macquarie. Please go ahead.
Hi, sir. Good afternoon. Sir, I had two questions. One is, so in terms of the clinker capacity, so if I take out the new expansion that you are saying, you are anyways well balanced on clinker capacity at least at a company level. Now going ahead, at one end we are looking at increasing our blended cement ratio. And if I look at the incremental clinker and incremental cement, it is pretty much implying very high clinker factor. Like against the 11.4 clinker, you have effectively announced 12.5 million tons of cement. So what is the thought process?
19.5.
No, sir, but out of this 19.5, large part of it was anyways work in progress, for which we were already.
Yes, you're right. Yeah. Okay.
So, what is the thought process behind this? So that was the first question. And secondly, while I understand, clinker brownfield is a great thing, very cost effective and all, but on the grinding side also, do you think that we have exhausted, opportunity to expand more in terms of geographical footprint? Because most of our grinding is also brownfield, so we are not kind of diversifying in terms of our locations, which could have been more, logistic friendly and all. So I don't know, have we kind of exhausted that opportunity or?
No. So it's within the state also, we have to cater to a market. Now, if in and around Calcutta, and what is it called? Suddenly the names are not ringing in my mind. The geography that is a core market. Patna is a core market in Bihar. We have to address Patna as a market. And if I am able to cater to Patna by expanding my Patliputra capacity and being fully sold out, there's nothing wrong in it. Instead of doing a completely greenfield capacity and trying to create a new market. So we are Cuttack, Odisha. We have Ankit. We have Jharsuguda as one location, right? Odisha.
Yeah.
So we have only one location in Odisha. We are putting up Cuttack as a new location, and that is a happening place as far as cement consumption is concerned. That district, those bunch of districts in and around Cuttack. Dhule, for example, in Maharashtra, there is no cement unit within a radius of 400 kilometers. If I am right, it gives us a golden opportunity to again rebalance the material for us, which was coming from Awarpur, which is Chandrapur, which is closer to Nagpur. It reduces the lead distance. All these are depreciated plants. It reduces the lead distance, and I'm able to cater to the market, reducing my overall lead distance.
Okay. And so the first question on clinker versus cement, if I look at it on an incremental basis, will we be short on clinker in East? Actually, that's a point I wanted to understand, because if I see here, we are adding around 3.7 clinker in East if I put Mahir and Hidmi together, and grinding is way more than that, or as in multiple times of that, even though, as a starting point, we have been highlighting that East, we are bringing clinker from peripheral markets and all. So are we comfortable in terms of our clinker cement ratio, particularly for East?
Yes. One is East will be a composite cement market. So it's not our average is 1.34 or 1.33. This will go up to 1.8 or slightly higher. And Dalla Super, which is closer to Bihar. So Dalla Super will supply, Mahir will supply to, Mahir is pegged to Patliputra unit. Dalla Super 2.3 million tons will again cater to the eastern markets. More to eastern markets than to central markets. Central is self-sufficient in clinker. So clinker, which is total clinker coming on stream is 12 million tons. Major portion of that clinker will be used for the eastern markets. And Ultratech has always, played the game of having clinker in hand as compared to having an empty grinding capacity.
Right. And so just my last question on WHRS.
What happens is that Ashish, just to explain this point, if you have clinker, there are several small private players who can take capacities on tolling, take over that plant on lease, grinding plant on lease. We have done that in the past. Right. Take the grinding capacity on lease and use your own clinker. Clinker is the heart of cement. All of you know that. Yeah, sure.
Yeah. And so just lastly on WHRS, are we kind of, is 40% the best ratio possible for the incremental capacity that you highlighted, or there is headroom to add more eventually?
On the incremental capacity, this is the maximum possible.
This is the maximum. Okay.
So we are not waiting for a later point in time to do additional WHRS.
Okay, so this 57 that you said is over and above the 245 that's already there in pipeline for us.
Absolutely.
Okay.
And that is how the overall percentages will improve for us. of green power.
Green part. Understood. Thank you so much.
Thanks, Ashish.
Thank you. The next question is from the line of Rajesh Kumar from HDFC. Please go ahead.
Yeah, hi sir, good evening. While a few of the questions have been answered, I had two further questions. First, if you could share your regional utilization, even some ballpark number, that would help us understand, the current business dynamics. And second, out of the 6,500 crore capex, WHRS 57 megawatt cost is also included in that, or it is separate?
Yes. No. Everything is all included. It's a complete package.
Okay,
and as far as capacity utilization are concerned, I think we had given it at the end of last quarter. We will talk about this quarter at the end of December.
No, for FY20 also, if you could share those numbers on a FY20 basis, regional utilization.
Sure, I don't have it immediately. I'll ask Ankit to connect with you and.
Sure. And on the WHRS, again on the capex cost. So, X of WHRS, your capex cost is less than 6,000 crore.
Give or take, yeah.
Okay. Great, sir. I'll come back and see. Thank you.
Thank you. The next question is from the line of Naveen Sachdev from Edelweiss Securities. Please go ahead.
Hello, can you hear me? Hello?
Yeah, Naveen, hi.
Yeah, hi. So thank you. Sorry. Yeah, okay. So thank you for the opportunity. Sir, a couple of questions. I wanted to first of all ask just regarding the timing of the completion, as in towards end of FY23, essentially, then it ramp up and all that.
So, I'm not able to hear you clearly.
Can you hear me now, sir?
Away from the mic.
Naveen, this is the operator. I request you to move a little further away from the mic.
Okay. Can you hear me now? Hello?
No, it's
not very clear.
1 second. Is it better now, please?
No, sir, it's the same. So we request you to call us
okay, I'll dial back again.
Using a different device. Thank you.
Thanks.
We'll move to the next question. The next question is from the line of Milind Raginwar from Centrum Broking. Please go ahead.
Yeah. Hi, sir. Thank you for this opportunity. In the presentation, the clinker that we are talking of is including the Dalla Super, right? The slide 21.
Yes.
So the new capacity clinker would be 9.1.
No. Slide 21, I think it is the expansion only. Dalla Super is not a part of my expansion, but it has not yet got commissioned. That's why that's an additional capacity.
No, sir. If you add the total 4, Pali, Mayyar, Dhar, and Hirmi, the clinker addition is 9.1. So 2.3 is Dalla Super.
Plus 2.3 of Dalla Super, yes.
Yeah. So, okay. Just that wanted one thing. The second thing is, sir, on the slide, earlier slides, we are seeing that power utilization is coming down to 80 as of FY20. Hello?
No, not 80. Now, which slide are you referring to? It's an index number.
Okay. Understood. Sir, in terms of if now we calculate this 9.1 of clinker. Hello?
Yeah, I'm listening.
Yeah. 9.1.
Hello.
Yeah. So so the total mix of 11.4 to 20 million ton of cement. Sir, we will be able to balance this clinker cement ratio, or we may have we are still excess in. I mean, this is going to be balanced within the intermediate. That's what I wanted to understand.
Yes, we are fully balanced. We always carry surplus clinker. We are fully balanced.
Okay. Okay. And sir, Dalla Super, you expect? Hello?
The East market, the markets that we are looking at, can you hear me?
Yes, sir.
Hello?
Yes, sir.
The markets that we are looking at, the markets that we are looking at are composite cement, value-added cement. So the ratios are far attractive in terms of clinker consumption.
Okay. Just to reconfirm, Dalla Super, we said third quarter of FY22. Is that a safe assumption? December 21 is what you said in the earlier mention.
December 21 will be 2 million ton. December FY21, yeah. FY21, sorry. First one will be Bara to get commissioned. Bara line 2 will get commissioned. That's FY21, yeah. By March end it should be there.
And Dalla Super, sir, I'm more interested in the clinker part, 2.3 clinker at Dalla Super.
Yeah, the clinker Dalla Super will start production in fiscal 22. It's government formalities. It's nothing to do with the project work. It's government formalities, and as I was mentioning, one meeting got cancelled because of COVID. So we're just waiting for completing the government approvals. Anytime in FY22.
Okay, sir. Okay, yeah. That is it from my side. Thank you.
All right.
Thank you. The next question is from the line of Prateek Kumar from Antique Stock Broking. Please go ahead.
Yeah, thanks for the opportunity, sir. My first question is, when we say that we expect long-term demand CAGR of 8%, with the current set of expansions and capacities, do we expect to grow in line with industry, or like we expect to grow like 10% versus industry?
We grow better. We always grow higher than the industry.
Okay.
If you look at the data and the charts also that I have presented, Ultratech has grown much better than the industry. We'll continue to do so. And
right.
This is, it's no rocket science. It's more because of our diverse presence that we are able to catch opportunities in all parts of the country, unlike a regional player.
Okay. And just on these timelines which you have given for 12.8 expansion, all of them mention that Q4 23 or Q3 23. In another slide, we have mentioned FY24, which means that these expansions can spill over to 24. Because all these are like given like back-ended 23. So these can spill over to 24 as well? In terms of...
If there is some setback, some strike or anything like that, then there could be a push.
Okay. And one question on your Dalla grinding unit.
No Dalla grinding unit as in?
Sorry. My question was, it cannot be preponed from here. Is that a safe assumption, or it is either this or later dates?
I always keep something in the pocket.
Okay.
Something to surprise you with.
And on your this ongoing expansion of 6.7, this Dalla 1.3 million ton is an additional number, right? Which was not communicated earlier. So this is an additional number as well.
Actually, it's more. Yeah. It was not communicated earlier. We had started work. It's more debottlenecking. I thought might as well communicate it.
Okay. One last question on your profitability. When we say that we are looking to improve from here, over past 6-7 quarters, we have done profitability in the range of 1,000 to 1,400 with very strong numbers in past 2 quarters. So what are we looking at in terms of like 1,200 as a base case and like looking to improve from there?
I could go with you on that.
Sure. I'll get back to the queue. Thank you.
All right. Thank you.
Thank you. We'll be able to take the last two questions. We take the next question from the line of Naveen Sahadev from Edelweiss Securities. Please go ahead.
Yeah. Can you hear me now, sir?
Yeah, loud and clear.
Great. So thank you for the opportunity. Sir, my question first was just on the timing of these capex completions, in the sense that if it's coming towards end of FY23, which means the ramp up and bulk of the volume benefits starts accruing in FY24. X of South, it can be, because since this expansion is largely, it's not at all in South, it's in largely in North, Center and East. So for these markets put together, of the incremental FY24 demand, assuming 6-7% kind of a continuous growth year on, and then of course next year will be a much better growth because of the base effect. So 23 onwards, if I'm assuming a simple 6-7% kind of a growth, that comes to over 70%, of the incremental demand. So my question is, could these capacity timelines be a little more staggered so as not to impact the not just our but overall industry profitability, or what is the thinking on that front, sir?
So if you were to exclude South, then you will be pleasantly surprised that you are underestimating the industry. I'm looking at 8% CAGR for all India, and South and West grows the least. East, Central and North, you look at what Mr. Yogi Adityanath has announced, it's all in the papers, and I had the privilege of attending some meetings with the bureaucrats. The kind of things that are happening in the country in terms of development are fabulous. So Central East will pave the way for much higher growth for cement industry, for the Indian economy. North is already a flourishing market now.
Okay. No, my point was that.
Upwards.
Okay. No, my point only was, let's say, with ACC and the JK coming in Central India around the same time, is that likely to create some pricing headwinds for that industry in FY24?
When you ask them to stop, no, why are you asking me to stop?
No, I'm not asking you to stop. I'm simply just trying to get your views that since you said that demand can surprise, so great. We'll look forward to that thing. Sir, just a second question on this Ultratech Building Solutions. So what is the vision there, in the sense, how big can it be as an overall percentage of revenue, EBITDA? If you can throw some color there, because this is the first time it has been explained in great detail in the current presentation. So what is the vision there from a 3 to 5 year or a longer view, as in terms of revenue share or EBITDA share?
So, it will occupy a very small share of EBITDA because the bulk of EBITDA for the company will be driven by grey cement. It will definitely help achieve higher throughput for grey cement, because today also huge amount of cement is sold through the UBS network, and we are doubling the network from here in the next 3 to 5 years. And as I mentioned on the call, we will announce a blueprint of the UBS plan, as well as white cement plan in next couple of quarters for sure. Don't want to give you an arbit number out of the hat right now.
Okay, yeah, because I was only saying, is there a plan to enter into, let's say, allied sectors or industries related to building materials in a big way? Since we are already selling some of these products through our channels, is there a plan that we get into, let's say, a tiles or a paint kind of a thing?
Not at the moment. I think our expertise is in grey cement. We tested our hands with aggregates burnt our fingers and walked out of aggregates because India is not a market for corporates to play aggregates, unlike the Western world. We tried sand. There was Ultratech sand, by the way, but it came and it went without a whim. So grey cement, white cement will remain the core RMC, which is I would say which is a variation of cement, and UBS network or building products are closer to the heart for the individual home builder, and that is why those products become important. Tiles and paints, etc., that you talk about, that's not our core competency.
Sure. So just one last question, if I may. Can we say that with Ultratech as the industry leader coming forward in terms of such a material capex, and then also these smaller like Ramco, JK, each of these smaller players also looking to come forward, is it safe to say that the optimism in the industry in terms of demand is really, within just 2 quarters has taken like a full 360-degree turn, and then we are looking at a revival of the overall capex cycle for the industry?
Yes. You are looking at revival of demand, and the optimism is genuine.
Okay. That's helpful. Thank you. Thank you very much.
Thank you. We take the last question from the line of Swagato Ghosh from Franklin Templeton. Please go ahead.
Yeah, thanks for taking my question. 2 quick ones. So firstly, a clarification. If the demand surprises, say in the next 12 months, can there be preponing of some of the capacity plans that we have for beyond FY23?
Oh, beyond FY23, yes, we could, but our focus primarily is to first execute this 20 million ton and put it out in the market.
Okay, sure. And next thing is...
and there is only that much that one can handle in a plate at one point in time. So let us execute this first before we get on to the next phase of growth. There will be next phase of growth for Ultratech for sure.
Right. Yeah, that's good to know. And a related question is, so in the say next 1 to 2 years, if there are any inorganic opportunities, because you already would be having these executions like on your plate, would you still be interested in those?
It all depends upon how it fits into our overall network and how profitable it is.
Okay.
Balance sheet is geared up. Balance sheet is very strong. So we'll have to examine each and every opportunity.
Got it. Thank you.
Thank you very much. We'll take that as the last question. Ladies and gentlemen.
Thank you so much.
Thank you. On behalf of Ultratech Cement, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.
Thank you.